chapter 35, liquidity. So when I talk about liquidity, liquidity is just the ability of a business to have resources that can easily turn to cash. Do you get what I'm saying here? Liquidity is the ability of a business to have resources that can be quickly or easily turned to cash. That is liquidity. So what is the difference between liquidity, cash and profit? You know what profit is? Total revenue minus your total cost. The profit is not the same as cash, but cash is part of a business profit. So yes, it is important for businesses to recognize the difference between cash and profit. Differences between cash and profit arise for a number of reasons. One, during the year, a business might sell $200,000 worth of goods with the total cost of $160. Its profit will be total revenue minus the total cost, which is $200,000 minus $160,000. So the profit made by the business is $40,000. So the $40,000 made by this business, if the business receives, if there's no any credit sales in the business, that means the total cash is the same as the total profit. Yes. But if in that case, the business sells to some credit customers, the business has some debtors, it means you have to take away the debtors, the amount the debtors are owing you from the total profit, and that is the available cash you have. Mm-hmm. So for example, if your total profit is $40,000, as said, and you have your credit sales, your total credit sales to be $12,000. Yes. So it means your cash should be $40,000, which is profit, minus your $12,000, which is your debtor's value. So that means the total cash you have as a business is $28,000. Is it clear?
Yes.
So we are talking about the difference between cash and profit. 2, a business may receive cash at the beginning of the year. If a business receives cash at the beginning of the year, what does that imply? It means your cash balance will increase, but that does not increase your profit. Mm-hmm. Do you understand what I'm saying here? Yes. When you receive cash at the beginning of the year, it improves or increases your cash balance. It does not increase your profit. We are seeing the difference between cash and profit here. Do you understand, please?
Yeah, I understand.
Sometimes the owner might introduce more cash into the business. So if owners of a business introduce more cash into the business, it does not increase the profit of the business. Rather, it increases the cash balance of the business. Mm-hmm. Purchases of fixed assets will reduce the cash balance, but would not affect the profit of the company. When you purchase fixed assets, it reduces your cash because you are buying with cash. Mm-hmm. So it reduces your cash but does not affect your profit. So your profit is still intact. So the amount of assets you buy does not influence the profit you make. Do you understand? Your cash will be reduced when you purchase assets, but your profit will not increase or decrease. Is it clear?
Yeah.
Because your profit is as a result of your total revenue away from your total cost. It does not have anything to do with the purchase of an asset. Is it clear, please?
Yes.
Sales of fixed assets will increase cash balance, but will not have effects on the profit unless the profit or loss is based on a loss or profit of disposal of assets. So if you sell your assets now, it does not have any effect it does not have any effect with the profit, except if you made a profit or loss when you are disposing that asset.
Yeah.
Is it clear? Mm-hmm. Because you don't include the sale of assets in your business turnover. It's not always included in your business turnover. Your business turnover are what you sold as a business, your inventory. Do you have any question about that?
No.
We'll go to statement of financial position. When we talk about statement of financial position, it's a document or a financial document that summarizes a company's assets, liability, and capital. That's the statement of financial position. So we go to assets. Assets, these are resources owned by a business. The resources owned by a business, like the building, machinery, equipment, fixtures, furniture, motor vehicle. Mm-hmm. Then we have liabilities. When we talk about liabilities, these are resources that the business owns but does not belong to the business. Mm-hmm. Literally, we can say these are debts to the business. from the third party. Do you understand? Example, so liabilities are a source of fund to the business. They might be short term, like an overdraft, and a long term, like a mortgage.
Yeah.
They are sources of finance for the business, but they don't belong to the business.
Like
Capital, yeah?
Like loans.
Like loans, yeah. Capital is the amount of money the owner of the business gives to the business that has to be repaid.
Yeah.
So that means asset is equals to capital plus liabilities.
Mm-hmm.
So all those things will be used by the business, but some are for the business, which is asset. Some belongs to the owners of the business, which is capital, and some belongs to third party, which is liabilities. Mm-hmm. Is it clear? Now we go to the presentation of the statement of financial position. How do you prepare a statement of financial position? When you are preparing a statement of financial position, the items inside are your non-current assets, your current assets, your current liabilities, non-current liabilities, and your share equity. So we take it one at a time. Non-current assets. These are long-term resources that will be used repeatedly by the business over a period of time, like land, fixture, capital. They will be used repeatedly. They stay in the business.
Yeah.
They may be called fixed assets. Are you with me?
Yeah, I'm with you.
And sometimes they are also intangible assets. What are intangible assets? Like your brand name, like the reputation of your business. Mm-hmm. What else can I say? Franchising.
Yeah.
Okay, so these ones are part of intangible assets. They are not physical, they are non-physical.
Yeah.
Is it clear? Customer list, they are assets too.
Yeah.
So they could ask you, they might ask you in the exams, give examples of intangible assets.
Yeah.
I think it's clear.
Yes.
We go to current assets, which is part of the items in your statement of financial position. For current assets, these are assets that will be changed into cash within 12 months. They are the liquid assets. Mm-hmm. And when we talk about liquidity, the liquidity of an asset is how easily an asset can be converted to cash. Is it clear? Yeah. Examples of current assets, we have inventories. For inventories, we're talking about stocks, raw materials, components.
Yeah, good.
Yeah. So we have trade and other receivables. This relates to the money owed by customers. These are the debtors. And prepayments. Whenever you make payments ahead of time, they are your other receivables. Is it clear? Mm-hmm. Cash or cash equivalents. We're talking about the money now. This refers to the cash on the business premises. That means your cash at hand. The amount of money, the cash you have in the premises of the business or the one in the bank. We call it cash at hand, cash at bank.
Yeah.
Okay? They are still part of your current assets. Mm-hmm. Then we go to current liabilities, which is also another item in your statement of financial position. So what are current liabilities? Any sums of money owed by a business that must be repaid back within 1 year. They are current liabilities, like the short-term loan, like a bank overdraft. They are short-term, they are liabilities, current liabilities. Is it clear?
Yes.
We have trade and other payables, which is also part of an item in the statement of financial position under liabilities. So when we talk about trade and other payables, we're talking about money owed by you to the suppliers. You are owing other suppliers. The other customers are owing you are trade payable or trade receivables. The one you are owing your suppliers are trade payables. Is it clear?
Yes.
Another maybe accrued expenses, that you've taken, you've purchased, you've used, and you've not paid for. Do you understand? So we call these people trade creditors. Mm-hmm. Is it clear?
Yes.
Then we have also current tax liabilities. These are taxes you owe to government. Is it clear?
Yeah.
Now this refers to money owed by a business to the tax authorities, which is the government. This might include employees' income tax, also corporate tax, that's tax for profit. They have to be paid, they have to be repaid within a year. Is it clear?
Yes.
Then we have non-current liabilities. They relate to long-term loans and any other money owed by the business that does not have to be repaid within a year, like mortgage. It has to be more than a year.
Yeah.
Debenture. Then we have net assets. So what is net assets? Your total liability, your total asset minus your total liability. Do you understand? Your total assets minus your total liability gives you your net assets. Is it clear?
Yeah.
And your net asset will equal to your shareholders' equity.
Yeah.
Okay? So what is shareholder equity? This provides a summary of what is owed to the owner of a business. So what you are owing to the owner of the business, your share capital. Is it clear?
Yes.
All right. How do you measure liquidity? We already know what liquidity is, right? The ability of a business to turn resources into cash. So how do you measure liquidity? So before we go into that, it is important that a business is able to meet short-term debts. If a business is able to meet short-term debts, it means the business has liquidity to be able to meet up with its expenses or expenditures or its bills. Do you understand that? So how do we measure? There are two financial ratios to measure liquidity. We have the current ratio and the acid test ratio. So for the current ratio, it is current assets divided by current liabilities. Then we have the acid test ratio, which is current assets minus inventories divided by current liabilities. So your inventories will be opening inventory plus closing inventory divided by 2. Opening inventory minus closing inventory divided by 2, sorry.
Yeah.
Is it clear?
Yes.
There are ways to improve inventory. How can you improve inventory? One, you can sale of asset or lease back. So you can sell your assets. When you sell them, you improve your inventory. Then what happens then? Or sales and lease back. You sell and get back the lease. You sell it and get back. Do you understand? These are ways to improve liquidity, sorry. Ways to improve liquidity. Is it clear? 2. Yeah. 2. Supplier credit terms. So you buy on credit. You pay at a later, you use credit suppliers. So whatever you buy, you don't pay at that point in time. It helps your liquidity.
Mm-hmm.
Is it clear?
Yeah.
The third one, factoring. This is when a specialist company pays the debt owed by a business, but with certain percentage deduction. Here, maybe I'm owing you. I can't pay back. Then we can use a specialist company to debt factor my debts. So what would the company do? The company, if I'm owing you 20,000, the company might pay you 17,000, and the company will be taking that debt from me. So the company pays you off. That's what we call debt factoring. Is it clear?
Yeah. Also,
we have inventory JIT. That's just in time. So you don't keep inventory. Rather, you get them whenever they are needed. So when you need to produce, that is when you get the inventory. You don't keep inventory. Because when you hold on to inventory, you are holding on to cash. It means cash has gone for those inventory to stay. So for those inventory not to stay, you have cash with you. So you have liquidity. Mm-hmm. So you only need, whenever you need the inventory, you buy them. Mm-hmm. Is it clear? Yeah. And for the inventory, I told you, it's opening inventory plus closing inventory divided by 2. So we go to working capital. What is working capital? This is sometimes called the circulating capital. It is the fund left over to meet day-to-day expenses after current debts have been paid. So the amount of money you leave when you have paid all the debts of the business to run the business daily is what we call working capital or circulating capital. Is it clear? Mm-hmm. So the formula for working capital is current asset minus current liabilities. Not the same as current ratio. Current ratio is current asset divided by current liability. For working capital, it is current assets minus current liabilities. What are the factors that determine or influence the working capital of a business? 1, the size of a business. How big a business is will determine the amount of capital, working capital the business needs.
Yeah.
2, inventory level. So the more the inventory of a business, the more working capital the business needs. Mm-hmm. 3, debtors and creditors. The time in between you are able to get the money from your debtors and you're going to pay your creditors will determine what kind of working capital you need to make available. If the time frame is not so much, then there's no need to have much working capital because you receive from your creditors, you pay your debtors immediately. But if the time within them is longer, then you need more working capital. If not, you run out of cash. Are you with me, please?
Yes. Then
we go to the importance of Cash. Cash is the most liquid of all business assets. The one that is easily spent is cash. 2, cash is part of, but not the same as working capital. As working capital includes other current assets such as debtors. But this cannot be used to pay bills. So definitely what literally we're saying, cash is used to pay bills.
Yeah.
Is it clear?
Yeah.
The third one, cash is vital to a business. So without cash, a business will cease to exist.
Mm-hmm.
Do you understand?
Yes.
Do you have any question about it?
No.
So that's all about liquidity, chapter 35.